Joining me now is Jeff Currie. He is the global head of commodities research at Goldman Sachs. Jeff, welcome to you. And I think the most important point to make here is that you don't think these high prices are because of this conflict. You think they're fundamentally driven by supply and demand, right?
Oh, absolutely. We look at this trend in oil prices and commodity prices. It dates back to September of 2020. It's been just pretty much a straight line up since then as inventories draw down, get to critically low levels, volatility spikes. We're now in a scarcity premium across all these markets. It makes them really exposed to any kind of disruption. And that's what we have going on in Russia, Ukraine. While our base case is you're not getting a disruption because it's just no one's interest, and the sanctions announced yesterday are not going to disrupt energy. But I think the key point here is that, let's call them shadow sanctions, are leading to disruptions in Russian supply. Crude oil, Russian crude, Urals grade is trading at a $12 discount to Brent right now because people do not want to take this oil due to credit risk, legal risk, sanction risk, operational risk. They don't want to send boats up into the Black Sea. Even the Chinese are not taking Russian material, whether if it's crude, metals, grains, whatever it might be. So, yeah, the market's off today. But the reality is the physical market, which is already tight, is getting even tighter. And one last point I want to say, while there's a big range of potential near-term price outcomes, the structural bullish story is just reinforced by these events because the sanctions on capital flows, particularly the banks in Russia, will make it difficult to invest further, reinforcing this underinvestment thesis.
At just one point you made there, so even China is not taking delivery of Russian commodities?
Yep. As of this morning, the banks were not, providing commodity trade finance to be able to load, Russian oil, even on Chinese ships. I think, there's not only the issue about financing, there's also the issue, do you really want to send a ship up into the Black Sea right now? It's hard to find crews to go do that.
So let me ask you about demand. What you're speaking to especially is the fact that demand has outstripped supply. Like you warn, if Russia can't invest right now in increasing supply, then, that makes it worse. But what about those, including the Fed, who are going to be looking at the global demand response here and wondering if we see a slowdown?
Well, I like to point out a couple of things that when we see a Fed pivot in rate hikes, 12 months after a rate hiking cycle begins, crude is always higher, on average 30% higher. So if we were trading, let's say 95 at the beginning of this rate hiking cycle, means we're trading 125 or 130 on average throughout historical rate hiking cycles. But I want to emphasize it takes a long time to actually slow commodity demand. So it's not something you start hiking rates and pivot tomorrow. Yeah, it may impact the equity market, but remember, these are physical markets. It takes time to slow the demand and start to turn that ship around.